Newman here with a Fat Tail Investment Podcast. And I've got another great guest for you today. His name's Peter Bakker, aka Chewy, which is his nickname, who builds algorithms to trade the market. And I've been following, he did one for Fat Tail Investment Research I think last year at launch. Maybe it was even earlier. I can't remember now. But anyway, I've been following it the whole time. It's a really interesting operation, and it's very helpful in determining your risk in the market and all sorts of things about what's going on in the economy and the world. So we're going to get Peter on to tell us today about what the algo is saying and a little chat about crypto too. So he's fairly secretive about what goes into the algo, but I must admit I did just drop into the office the other day and I did see a very interesting character there. I took some footage on my iPhone of him, just a bit, just got a short bit before he saw me recording him. So let me show you that to you now.
Ooh, input. Hound of the Baskervilles. I think the chauffeur did it. He did.
And as you can see, that's a very complicated bit of machinery that Peter's put together there. Hence why I call the algo Johnny 5. I can't say for certain that that's what's behind the algo, but I suspect it's true. Now, Peter has been building algos since at least the last 10 years. I think he's been in the markets for 20 years. So he's a very experienced operator. And as you'll learn in this conversation, not only is he trading US stocks, US markets, Australia, he's now moving into crypto as well. So it's a really interesting discussion. So here he is, Peter Bakker, aka Chewy. Alrighty, here he is, the famous Chewy Bakker.
Famous. I don't know about that, Callum.
Famous on certain forums. I wanted to get you on to talk about your algorithm. It's fascinating thing that you've built, and obviously algorithmic trading has become a bigger part of the market. Mm-hmm. Before we dig into today's market and how you view things and how the algo sees things, can you tell us what were your goals when you built this algo? What's it designed to do?
Well, the main thing that the algo is designed to do to determine whether you should be in or out of the market. And, what algorithms, when they are built with AI and machine learning, they basically try to find the probability of a crash or the probability of no crash. So you can have a hypothesis two ways. And so this algorithm primarily says you should be in or you should be out of the market. And it does that based on the metal complex. So all the metals you can divide in productive or hedging metals. And productive metals like aluminium, steel, copper, etc., they tend to move with the market plus supply and demand. And the hedging metals, they usually get a kick when the market is stressed, right? So that's the main thing. Normally, risk off means go to bonds, which is at the moment not such a good idea.
Well, we'll come back to that a little bit, but as far as I know, that it has three settings. It's either 100% equities, 100% cash. Oh, sorry, there's 100% bonds or a mix of those two,
yeah,
right?
So basically, officially it has 6 of them, right? So 100% cash and then 60-40 bonds, equity, 40-60 bonds, equity, 100% bonds, 100% equity, or there's another mode that I don't know, I don't really use, but it's where you go levered. But yeah.
Okay, and I would say for a long time now, probably even since you launched first the service, rarely has the algo been 100% shares. Is that fair to say?
Yeah, there was a small period in last, I think July, that it was 100% shares. But that was a very short period. Yeah, the when you go 100% shares, you have to basically make sure that first the volatility complex, so the stress, is very low. And secondly, you want to make sure that the economy is zooming. And zooming means a lot of things, right? It means that the interest rates are stable, that the rates of the growth rates of the metals are steady, the growth rates of the economy are steady. So basically Goldilocks, right? But yeah, problem with Goldilocks in the last 10 years is that Goldilocks is a lot distorted by the Federal Reserve and other banks, right? But,
Well, I'm just thinking here, the Aussie market peaked in August last year. And I mean, if you look at it since, there's been lots of ups and downs in between, but it's basically gone nowhere. So the algo has been right. And I'm going to call the algo Johnny 5, just to give it a name, if you remember that movie. So Johnny 5 got it right. I remember you said once that the algo was built. You built it, I think, was about 8 years ago. So it was built for a disinflationary world at that time.
Yes.
Now suddenly we find ourselves in an inflationary world.
Correct.
Do you think that's problematic for the way you built it, or it will adjust to the market as it runs?
Well, it will adjust because it always looks at the whole complex of data, right? So it will adjust, but the states, it will still try to make the states 1 out of 6, right? And that means that yes, it will adjust, but some things do not adjust. If you look at, for example, the gold-copper ratio and its correlation to bonds, that correlation is there for the last 40, 50 years. That won't just go away. That was also still valid in the 70s. So, some things in the world are not fixed correlations, but they tend to correlate back to the ratio it did have at one point. And even when there was a huge discharges in the 70s where we left the gold standard, it still, in the end, the correlation went away, but then the correlation came back a few years later. So the disinflationary world only means that your risk off you have to treat very differently. So, for example, now I say to the subscribers and also in my own portfolios, I do not buy straight bonds, but I still buy bonds, but I buy different types of bonds. So either I buy TIPS, which are inflation protected bonds, or I use a ETF called RISR, RISR, and that's basically a set of short-term treasury and floating rate mortgages. And that thing, I bought it at 28, now it's at 31, while the market went down. And so, you have to be flexible in the instrument you take, but I do believe that grosso modo, the algorithm is very good at finding when you should take risk and when you should take risk off. And now we're still risk off.
It does seem interesting as an outsider observer because bonds have been getting butchered lately in the US, at least the 10-year one, as far as I know.
Yeah.
And yet it's buying bonds and you're making money. How is that making sense?
Yeah, no, that's true. So bonds are extremely complex instruments, and it is because there's not only the interest rates, which is you have to contend with, but also the duration of the bond. So when the interest rates go up, everybody knows bonds go down, but that's only because the other factor is fixed, the interest rate of the bond itself. So when the relative interest rate changes, something has to change to become in balance again, and that's the valuation of the bond. So when now the interest goes up, the interest rate of the fixed interest bond is fixed. So the only thing that can change is the valuation of the bond to make artificially the interest go up. Yeah? Because when the bond goes down, your yield goes up. Well, then there's other types of bond. There's floating rate bonds. So, for example, mortgage bonds. So that's why some REITs are now a very good way to hedge yourself against the rising market, because REITs usually have floating rate mortgages as part of their portfolio. And so when the interest rate goes up, then also the rate of the mortgage goes up. So the relative impact on the price will be close to zero or actually positive. So that's basically the trick. The other one is the expectation of inflation, right? So you can protect yourself a little bit to the tips, which adjust to the inflation. But at the moment, the inflation is already in the US is already 7-8%, right? And my friends in the US say 7-8% is the official rate, but if you go to the store, it's more than 10%. So that means that the only way to protect yourself in a risk-off signal is to go to a more flexible bond instrument or cash. But
when you built the algo, so often we hear about if you want to go risk off, as you call it, like defensive or what have you, there's an argument for gold, especially in an inflationary environment.
Yeah.
Did you ever consider Johnny Five having a gold allocation?
Yeah, Johnny Five had in his originally version had a gold allocation, 20% in risk off. But although that has a very good influence, you make it also complex for people to follow. So then we decided at one point we back tested without the gold, and that worked fine. I would say gold is gold, right? I would always go for, if I were running my own fund with this, then I would go for a complex that is partly floating rate bonds and commodities, because commodities in an inflationary environment will always survive. And you have land. So I was lucky enough to also in my portfolio to buy land, LAND, a while back. That is now 75% up, just because land values in general are pretty sturdy when it comes to inflationary effects. So yes, land value. Gold is a strange beast, because personally I am actually quite amazed by the movement of gold in the last year. I would have expected, or actually in the last 2 years, I would have expected it to be a little bit more bullish. And it is not. So yeah,
Do you think crypto might be a part of that story? As in taking away some of the demand that might have eventuated there, or just it's one of those market mysteries for the moment?
I would say that's one of the market mysteries, because if you look at, there's $100 trillion now in asset management funds, right? That's a massive amount. All the crypto market together is just shy of 2 trillion. So, yeah, probably you have the right number, but I remember the gold market to be about 8 trillion.
I think so. I can't say for certain, but it's pretty.
So I don't think an asset class that has penetrated 10% of the population so far, and that is 2 trillion, can have a lot of influence on a market that is 4 times as big, or on the other side is 50 times as big. So I don't think crypto has anything to do with it. Besides, crypto if you want to go risk off in crypto, you basically are yield farming, right?
Well, are you building algos for crypto?
Yes, I do. Yeah.
You've already got one out there?
I have quite a few fun ones. Yeah. Yeah. Yeah.
Okay.
So crypto is a very, very interesting asset class because it has all the properties of the normal asset market, but it moves far quicker. But it also has a lot of innovation that you didn't see in the real world, like aside from the custodian part, right? So that you can be your own bank, which personally I think most people don't care about. But the fact that you can have banks built on a blockchain instead of a big building with a lot of old gray men in there, that's very interesting, I think. But yeah, now you see all these yield farming in DeFi, all these yield farming protocols, and it's very interesting because they seem to yield higher than would be normal in the economy. So there must be something going on there with leverage and re-leverage, etc., etc.
With Johnny 5, your regular US stock market bond algo, you're teeing off copper and gold and things that are, or at least partly rooted in the economy. With your crypto one, it's its own little world. Those traditional metrics, I presume, don't work in that world. So what are you teeing off a little bit? Momentum, volume, or?
Yeah, so I use a lot of what they call on-chain data, right? So you can read a lot about the markets because the blockchain is completely transparent. So you can see, for example, Callum, you can, if I would want to know how many people in your service, for example, are in profit, I have to interview them one by one, right? And then I have to assume that they tell me the truth. But in the blockchain, I can see who is in profit. I saw when they bought it. I saw when what their holding is. So there's a lot of things you know that you do not have to guess anymore. And so, yes, the algorithms on the blockchain were completely different. One of the things that I'm doing, which starts slowly to decay in terms of performance, is in the option market in crypto, there's a lot of amateurs. And so it's very easy to sell.
Take their money? Sorry, say again. I laughed over the top of your answer.
It's but so you can buy and sell premium in the option market very easily, and which yields quite a bit. So there's a lot of things going on in crypto that you can abuse, but usually we work a lot with machine learning and AI, and we look at the patterns we find in the on-chain data and in the off-chain data. So now you can also, what I'm now working on is actually because all the projects in crypto, they are dependent. They're dependent on each other. And so Link, for example, is an oracle, right? So if you see how many people are connected to Link and how many projects are using Link as their oracle, that you can see something about the progress of Link. The same you can see in Matic, and the same you can see in Engine, etc., etc. And so in the end, what you can do is you build a big graph of all the projects you can find, and you see what the dependencies are. In the normal economy, that's done in banks. So the RBA, for example, they map with the banks the dependencies on a bankruptcy, for example, from a big builder, or suppose Meervac goes under, what will happen then, right? And then what they basically do is they make a large dependency graph, and they say, okay, if this bond will fall over, then this bond will fall over, and then this company goes bankrupt, and then this bank is exposed, etc., etc. Well, in crypto, you can see that live and direct happening all the time. And so the algorithms are far more complex, but also I've seen that there's a lot of dirty data out there, a lot of wash trades. You know what wash trades are?
Yeah, it's like when they put it through and then buy it back kind of thing, right?
Yeah, they basically become their own market maker, right? They become their own liquidity provider, which is forbidden in the normal economy, but in crypto it's still allowed.
I'm just thinking, in terms of your exposure, though, like crypto is obviously higher risk. So is there a limit to how much you'd put on that algo just in terms of position sizing?
Yeah.
Like it's one thing to put, 500,000 in a bond fund compared to the crypto market, I presume.
So it depends on a lot of things. Also, your age, right? I'm an old fart. I have glasses, gray hair. So you have to.
Nothing wrong with that.
No, the how I see it is as a pyramid. I mean, I'm moving away from a barbell theory because barbells are hard to explain. Now I'm in a theory that is a pyramid, and the base of the pyramid is normally is very steady Eddie stuff. So your house is in there, also bonds, and then you have a layer upon it that is, for example, stocks, and you can have layers in it. So you say, well, there's the dividend-paying Westfarmer stocks, or you have the more smaller Appen and Afterpay or Block stuff. But and then you go up the pyramid, and you, for example, can have some money you invest in startups through Virtual or through one of the other crowd equity things. And then on the top is crypto for me. And it's a small exposure. And the hardest thing about a small exposure that is successful is when do you rebalance. But because at one point this triangle will creep down and become a big part of your wealth, which if you are sanguine, you don't want to have it too much it's just too volatile, right? So volatility in the end can kill you. There's a metric quants always follows is the daily value at risk, and if you put that formula in the crypto world, then the daily value at risk is like 12%. So it's reasonably to lose 12% in a day. Oh yeah, in a normal stock market, that's not reasonable. It's like 1.2%.
And just, do you have any? When you first launched Johnny 5, you said that you could have sold it to the hedge funds, right? But you wanted to give it to retail investors and help them along. Do you have any plans to launch a crypto version of Johnny 5 to anyone that might be interested, i.e., the listeners of this podcast?
Yes, I'm toying with the idea. Yeah, because it's actually very accessible. I'm trying it now with a few things, and it's very accessible. So yeah, I'm playing with the idea. But on the other hand, the crypto industry, although people think, oh, it's so big and billions go left and right, in the end, it's not so big. In the end, if the what you call the parcels, so if you look at the order book in crypto, the parcels itself are very small. So what often happens is that if you do an order with a whole group, so suppose we get 1,000 subscribers and they all start to do the same thing,
you'll move the market.
Then you move the market. So that's basically what I'm looking at now is what's the capacity? Because the interesting part of if I have an algorithm that says risk on, risk off, and I say buy the market or buy bonds or be cash, then I know we can't move the market. It's just too big, right? So crypto is just very small still. And especially when you go to specific projects. I mean, I've seen some of the recommendation of Dins, and I just see when he does something, you see it, and you see poof, spike. And, yeah. So yeah.
All right, so let's bring it back to First Mover Algo Alert, which we're calling Johnny 5 today. You made a comment that you don't expect the share market to do particularly well from what you're seeing now in the economy and whatever.
Yeah.
Do you want to put some thoughts down about why that is? Like your personal view, not what the algo is saying, what you're seeing right now.
Okay, so my reasoning is based on inflation and what inflation does to the economy. And so the moment there seems to be a sweet spot in inflation is about between 2 and 3%. And then basically the economy chugs along, and we slowly create more money, basically. But when it comes to 7% and 7, 8, 9, 10 in that direction, then people start to behave very differently. Certainly the 2% they had, they don't necessarily go to their boss and say, I need more money. But if they, in the beginning of the year to the end of the year, suddenly have 10% less salary, they say, hey, shit, everything around me got more expensive, but I still have the same amount of money, so I need more salary. And then people start to negotiate for the salary. The moment inflation goes to wages, it becomes sticky, and it starts to accelerate. Because what happens now, the wages or the input costs are higher, and the prices need to rise again, and then it becomes a spiral. And that spiral went really, really wrong in the 70s when you had the oil crisis, and you had some other stuff happening. Idiots putting nuclear things everywhere, and it was not a very stable time. What you see now is a disruption in the energy sector in Russia.
Yep.
You see, I don't think the geopolitical stability is really at risk, but that's more because I'm positive by nature. But I do see this upheaval in the oil sector, plus a high inflation, plus inflation shifting to wages, that we are going to have a period of instability in the markets. Because high inflationary, in the beginning, high inflation is usually positive for stock markets, but in the long run, it's always negative. It destroys equity.
So I'm thinking if someone's listening to this, they've got their money in a default super fund, suddenly they're going, oh, geez, it's may not make much money this year. No. It's not obvious to me. Do you think this year is going to be difficult to extract alpha from the markets? In a passive kind of way? In the sense, obviously an active trader can try and, short the dips and buy the rallies and things, but it's not necessarily obvious. As you say, bonds are not going to make you a lot of money. Where do you think alpha might appear?
Yeah, like super funds are not only is their problem that they usually have a very plain vanilla way of investing, they also are so big that they cannot easily move to cash, right? So no, I don't expect super funds to do that well. But what super funds also do is they invest in other things like solar farms and startups and scale-ups and IPOs. So they actually invest in things that not always accessible for you or me. So
Yep.
they might get some stuff out of there. If you look at the so sometimes, Callum, it helps to look back, right? So what would you tell yourself in 2000? Well, in 2000, I told myself, like, oh, damn, I'm already too late for the internet, right? Everything is done. And then I was right for 3 years because the market went down. But no, we were late. We were early in 2000, right? The big development came afterwards. And it's the same what I say sometimes to my wife is like our kids will be saying either one of two things, right? They either say, my dad is a genius. He started very early in crypto. Or they will say, my dad is an idiot. He spent all our inheritance in crypto and went to zero. I think it's pretty.
Well, just picking up, it sounds like you're a bit of a convert to crypto. You see that as the new internet, then the new asset class.
Yeah. I think.
Do you think it's because it's not just attracting a guy like you as a investor, but as an engineer and that kind of thinking that they're building products, they're building projects?
Yeah, I think so. In the beginning, I was skeptical, right? So because like most people, they say, "Oh, it's only for criminals and for drugs and extortionists," and then slowly you saw this move that people build applications on it. And when you look a little bit deeper into it, it's not about the applications per se, and it's not about. I mean, the hardcore internet, the hardcore crypto people who say that the whole net will move to a certain different model, they might be right at one point. They might be right that people, as a species, we are going more to self-governance and self-custody. And yeah, I think there's a big chance it's going to happen. Let's put it this way: in 2016-17, I think the governments as a whole could put back the genie in the bottle. Now the genie cannot be in the bottle anymore. It's too big, and it's something that you cannot regulate away anymore.
And do you put Bitcoin at central to that asset class, as you call them, the hardcore crypto guys do?
You know, so this is the thing that I disagree with the crypto guys a lot with, and every time when we discuss this with them, I at one point have to say we have to agree to disagree. So the hardcore crypto guys say banks cannot be trusted. People want to be their own custodian. People want to have their own money. And my argument is, really? Why? People want to live their life. They want to raise their kids. They want to sit on the beach, have a beer in the pub with their friends. They're not really busy with money that much, and so they rather have. They don't want to be their own bank, but they want to have the feeling things are more fair, and that's where it starts to cross over. So I think what will happen at one point is that there will be a hardcore group of people that want to be their own bank and be their own custodian of stuff, but there will be another group that will be more practical and saying, well, you can actually give your money to me and then I'll make more of it as a manager, but then on the blockchain. You can see what I do because it's actually on the blockchain. And there will be a group of people that develop applications that saves actually money. I mean, the whole, I don't know if you bought a house, but the whole buying a house thing, going to surveyors to check contracts and this and that, and then checking your titles. Why checking your titles? It should be on the blockchain. It should be just there and open, right? So you'll see that there was a lot of practical examples of crypto apps that we will create a lot of
efficiencies,
and we save money, and we may just make it better and more transparent, right? But do I really want to be my own bank? Don't know. Don't think so.
I have a friend who's heavily invested in Bitcoin, and he argues that it's the most trusted network, and therefore it attracts the most capital, if you like. So, by your observations, do you think Bitcoin's overpriced?
Oh, that's a different question. The price of Bitcoin, I think. So at the moment, when I look at the on-chain analysis I'm doing, it's underpriced. Yeah.
Interesting.
Yeah.
Do you have a level in mind when you would buy it, or do you view it as a tradable thing?
I'm very disciplined. I buy every month. I buy a fixed amount.
Of Bitcoin or crypto?
I buy a fixed amount of Bitcoin, and so I take $500 for Bitcoin every month for the last many years. And I take another $500 and I find an interesting project.
Okay, cool.
And so yes, I have a wallet with a lot of zeros in there. Zeros, like things went from 500 to 0 because the interesting project was just interesting for the founders, not for me. But there are a few big winners in there, and that's why I say the pyramid is important. The pyramid is important. You have to keep that part, and then when you hit a big one, just take some money out, put it in the safe stuff, put it in your house.
Well, for anyone listening to this that don't have your abilities to build an algo, I'd say they can subscribe to your service, of course, but in one level, you're not expecting, I don't want to put it like not expecting much alpha from it, because you can by using leverage and different strategies around it. I always take note of what it's spitting out too, because obviously I run my own self-managed super. I see that Johnny 5 is still a little bit cautious. Well, that makes me a little bit cautious too. So it doesn't have to be a money-making thing too. It's also a market sentiment kind of guide, if you like.
That's how I use it, right? So and because if it spits out 100% bonds, I will say, well, yes, bonds, but for me it's more like, it's 100% protecting itself. Yeah, so let's find ways to protect yourself, and it could be just by putting some options on your portfolio because you don't want to sell your equity because then you have a capital gains event, right? So it's what people do with it is always different. Yeah, but
absolutely. No, I love it, and I'm very grateful that you put it out there. All right. Well, just to sum up today then. So you've already got your Johnny 5 ASX one, and I know that you have other ones that are variations on similar themes. You're building crypto. Finally, actually, I should mention, you sent me an article a while back when you're in the paper talking about a service that you're building. Can you tell us a little bit about that to finish?
Oh yeah. So basically, we have an app that helps to invest into more advanced strategies. It's based on a fund, and so we run the strategies. We run several algorithms, and people can follow them with the app and invest with the app, which is very interesting.
What's the app called?
Oh, it's called Unhedged. Unhedged. Yeah, some people, because of my Dutch accent, they said, "What is it? Unhinged? No, unhedged." Anyway, so yeah, Unhedged, and
do you pay to download it, or does it come free and then
it's free to download, and you can. So what we have discovered is, because we are the only one that shows also as a demo mode, so people can actually see what we trade. So some people said, "Oh, why did you tell what you trade? Because I can see what you do, so I can do it on my own account." So yeah, well, yeah, okay, you can do that.
So how is this different from First Mover Algo Alert, the one that we were talking about previously?
Because it's a complex of 3 algorithms, and so there's a momentum algorithm, and there is a what they call risk parity. So it's basically an algorithm that looks at all the sectors in the market and then says, well, the highest chance for these sectors to overperform is this one or that one. So it's based on the theory of Ray Dalio, that you want to have not just portfolios of assets, so like most people have, but you want to have portfolios of return streams. So you want to have different ways of looking at the market. So you are looking at the market from a very, for example, a gold point of view. What's gold going to do, and what's microcaps going to do? That's a great service because it's one form of return stream, but you shouldn't see these assets as individuals. You see the whole strategy as, this is my expected return. Then you have your financial advisor doing a bond strategy. That's also a return stream, right? So, and the art in investing is to combining these return streams in such a way that your whole portfolio becomes independent. Independent from what the market does too much. But
who is the audience that who is this suitable for, this unhedged?
Unhedged is basically suitable for most people who like investing and want to try something else that is a little bit more advanced than services that just buys ETFs and stuff, right? So we just don't go to the market and say, give me a portion of the Nasdaq and of this bond and this. No, we actually buy the individual stocks. So we hold now Fiserv, we hold Goldman Sachs, we hold Google.
So it's US market stocks?
US market stocks at the moment. We haven't launched an Australian version of it. We're looking at it. We're also looking at to go into blockchain. So we will have a blockchain service soon this year. It's really exciting. But for who is it? It's primarily for people who don't have the time to invest themselves, but are still very interested, still want to have the control, still want to see what's happening.
What's the feedback been? When did you launch it?
We launched it just 6 weeks ago. We spent 1.5 years building the service, so building the back end and front end, and so we have now about 1,200 investors. So it's really quick, actually. Yeah.
So, without being too rude, how do you make money from it? Do you have, if you don't pay for the app, how do you get a fee off it?
Yeah, so the main this is my passion thing. I do think the financial world is geared against the everyday investor, and so what we do is we try to charge the majority of the fees only when we hit a high watermark and do better than the market. So, to be honest, we had a fantastic December, January, and February. And then March was tad down, but then you don't pay fees that month, right? And then we have to be better the month after or the month after. So it's
I'm just going to download it now.
it's more aligned. It's more aligned to your own incentives, right? So this is really, I think, when we talk about crypto and being your own bank, blah blah, it's the other extreme. This is more like, okay, but let's first align the incentive between money managers and clients. And if we do that at large, I think the market would be a lot better.
And I presume you've got your own money following this
100%
as well.
I have 90% of all my money in it. And I just bought a house, and I still have my down payment in it. That's how much I trust it.
You bought a house in Melbourne?
Yeah, I did. Yeah, I just waited until I could find the top of the market, and then I bought.
Well, you've done well. Picked it to a T. No. Cool. All right. Well, thank you for coming on today. It's always fascinating talking to you. I always want to come around to your office and discover all your secrets whenever I talk to you.
Yeah.
Although I'm sure I wouldn't understand half of the blooming formulas you use.
So we have like 3 PhDs now working for us, and so I gave up on trying to understand them, right? So it's like, gee, that's another level what they're doing, right? The machine learning and the AI, it's really fascinating.
Maybe let me come along to the Christmas party or something. I'll see what you guys are like.
Yeah. Maybe we're fun even.
Cool. All righty, mate. Thank you for coming. And of course, if you're listening to this and you're interested in Peter's work, we'll put a link into First Mover Algo Alert.
Yeah.
And of course, you can download Unhedged, and I'm going to download Unhedged, see what's going on there. I'd sort of forgotten that you'd done that project, and I didn't realize you had it out there already. So I'm going to check it out.
Okay. Thank you.